What's going on, guys? Freddy Finance here, and after watching this video you're going to know the difference between a stock, mutual fund, and an index fund. Knowing the difference between the three can be really confusing, especially if you don't have a finance or business background. So I'm going to try to break it down as simply as I can. If you want to learn more about how money works and how to make it work for you from a real wealth management professional, then please hit that like and subscribe button. When you buy a share of Apple stock, you are literally buying a percentage ownership into Apple. So your investment in Apple is directly tied to how Apple performs as a company. You can buy stocks at brokerages or investment companies such as Vanguard, Fidelity, or Robinhood, and you can buy these investments inside the different account types like I went over in my previous videos, such as retirement accounts, which is an IRA, or non-retirement accounts such as individual brokerage. You can make money with stocks if you sell them for more than you bought them for, and you can also lose money at the same time if you sell them for less than the amount you bought them for. A few important things to know about stocks are that investors who tend to hold them for the long term do much better than investors who don't, and it takes a lot of money to be able to fully diversify into a portfolio of individual stocks. Mutual funds have become one of the easiest ways to diversify and passively invest in the stock market. Mutual funds are basically pools of money from a bunch of different investors managed by professional fund managers that are trying to invest based on the objectives of that particular fund. And there are a bunch of different mutual funds. Each of them is diversified differently based on the investment objective of that fund. There are literally so many different types of mutual funds that they can tailor to all types of investors in all walks of life, like investors that want to be very aggressive, or investors that want to be very conservative, or investors that want to diversify into bonds. There is so many different mutual funds, and there's a very wide variety of them. If you participate in a 401k plan with your company, all of those different funds that you're investing in are mutual funds. Some important things to look out for when picking mutual funds are the expense ratio, which is basically the fee for investing in that mutual fund, and you need to make sure the investment objective of the mutual fund you're investing in is similar to your investment goals. And last but not least, index funds. Index funds are pretty much the same thing as mutual funds, except instead of investing for an investment objective, the index fund tracks a particular index like the S&P 500 or the Dow Jones Industrial Average. The most important thing you need to know about index funds is that it's a very easy way to basically buy a little piece of the whole market. So the S&P 500 is made up of 500 of the top companies in the United States. So if you buy a share of the S&P 500 index fund, then you are basically buying a little piece into each of the top 500 best companies in the United States. Being able to know the difference between the three is very important when investing, and especially when you're starting out. So if you got a better idea of the difference between the three after watching this video, please hit that like and subscribe button for more content like this. Drop a question in the comments if you got one, or let me know what you think. I'll see you guys next time.